2010 is the year of pension reform in Canada. Most of the proposals involve some way a modification or enhancement to the Canada Pension Plan, which of course has been around since 1966. Keith Ambachtsheer is the director of the Rotman International Centre for Pension Management, and he's going to take apart these various CPP proposals. Welcome back, Keith. Now, you're saying that basically, it's CARP and the Canadian Labour Congress separately are basically saying if we can double CPP contribution rates and also double the amount of money that it's earned on, instead of on a $45,000 base, maybe $90,000, that would solve the problem. You agree?
Well, it's got some really interesting, attractive features to it, because you're dealing now with infrastructure that's already in place. All you have to do is just dial the knobs to raising the benefit rate, raising the YMPE,
which is
the maximum earnings that the CPP relates to. So you could raise those, you could double the benefit, and you could make it mandatory, and your problem solved. And then the question is, well, it sounds very attractive, and it has some attractive features. Is there a downside to doing this? And of course, the biggest downside, to my mind, is that we're kind of bending the wrench on one particular formula. We're not putting diversity into the system. I think there is value in having diversity in the system. And I think the other element is that you can only take the mandatory part so far. I think once you get beyond a certain level, people want more flexibility. They want more options as to how they do things. So those are the downside of going in that route. It's one size fits all, and the fact that it lacks flexibility.
I just want to clarify. So if for the people who didn't have that registered, corporate employer pension plan, they're saying you could double this and expand the CPP. What if you already had a good employer pension plan? Would you not have as much?
Well,
CPP?
I mean, this becomes the conundrum of that approach, that you'd have to work your way through. You can't have both.
It'd be like a pension adjustment.
So the CPP would effectively override some of these currently existing defined benefit plan, and it would become the national pension plan for everybody. And that's somewhat scary.
And I mean, CPP as it is basically a pay-as-you-go scheme, which is defined benefit in nature, right?
Right. Well, the steady state, the current model is that it's 25% funded. It does have something like $125 billion in assets right now that will continue to grow.
In the stock market, essentially.
In the financial markets, a diversity of financial markets, but it's not 100% funded. But remember that the other, if you like, 75% of the future is the present value of the future contributions. So as long as we have an economy, as long as we have people working, and as long as the contribution rates are sufficient, which is reasonable under the assumption set out, we actually have a steady state system.
Now, I've often wondered, why do we have to have like the mutual fund company and the active managers and the insurance companies? Why couldn't they just invest those extra CPP contributions into essentially one giant index fund, global index fund? I mean, if they're young people, it's mandatory. We all know that 40 or 50 years of equities is all they need.
Right. So this is potentially a very long discussion. The thought experiment is, what if everybody went passive? How would prices be set in the market if everybody was passive? So there's an interesting question about the optimal amount of active management. It's probably a lot less than what we currently have. But the other thing now that CPP and some of the other major funds are doing are moving way beyond the stock market into, for example, infrastructure investing. So, they're buying hydro lines, they're buying, water systems in the UK, they're buying toll roads in Australia. These are all cash flow elements, and in fact, they're getting much closer to creating wealth, creating new wealth, rather than trading pieces of paper. So that's the other thing to keep in mind with this long-term money, is that if we do it properly, we can actually turn it into future cash flows.
Now, in your last paper, when you looked at the Australian system, you said you'd actually changed your opinion a little bit from when you wrote the High Noon report. You're a little bit more open to sort of a grand converged solution here. Right.
So it's not good. It's not good for our politicians to end up with being faced in June later on this year with three hard choices, and to have to pick one and therefore leave the other two on the table, because it doesn't lead to the kind of harmony and the kind of collaboration we like to see. What's happening in Australia, they're actually looking at how you can combine private sector delivery with some oversight that is purely fiduciary in the sense that it's being done by people who have no interest in that business, but are acting purely in the interest of the beneficiaries. I think combining those two ideas in a Canadian context is something that we should very seriously explore.
So you're basically saying they should have about 6 more months to really look at these 3 or 4 outstanding proposals and take the best of them all.
I was an advisor to the Federal Provincial Task Force in the 1990s that ended up putting some very creative CPP-QPP reforms in place. Without that task force, I don't think the job would have got done, because there's only so far that our political folks can take ideas. To actually turn them into concrete, actionable steps requires an extra level. I think we're now at that stage in Canada where we need to go that final step, impartial group, federal, provincial officials, to say, take all this research that we've done, we have a coverage problem, we have a cost problem, come up with a recommendation that's actionable, that takes the best of these ideas that are now on the table.
Thanks very much, Keith Ambachtsheer, the Director of the Rotman International Centre for Pension Management.
My pleasure.